Hey, everybody. Welcome back to another episode of the Unstoppable Podcast. I'm Diana Chen, your host, and I'm here today with my co-host, Matthew Gould, co-founder and CEO of Unstoppable Domains. Hey, Matt, how's it going?
I'm doing just fine. Got my afternoon coffee here, so I'm ready to go.
Great. So one of the questions that we've gotten a lot from users is, what's the difference between coins and tokens? There's all this talk about digital tokens, about coins, cryptocurrencies. We're going to dissect all of that for you guys today and break it down so that by the end of this episode, you know exactly what a coin is, you know exactly what a token is, you know how they're different, and you're in on the lingo so that when people are talking about these things, you know exactly what they're saying. So to start off, why don't we just, go right into it? What's the difference between a digital token and a coin? Maybe define both terms first before you get into what the differences are.
So to start off, I would blame Bitcoin for making all of this very confusing for people because they chose a really good name. Like Bitcoin is a fantastic name and it sounds like a coin. And if you tell your grandmother about Bitcoin, she'll probably try to go buy one on Amazon, right? And they have little Bitcoin tokens or whatever. But coin is just a word that they used in order to describe a database entry. That's all that is. And they could have called it like bit dollars or something. And maybe that would make more sense to people because, your dollars in your wallet or, at your bank or whatever, that's just an entry in a database. So that's all that is. And so Bitcoin was the first cryptocurrency. And, you think about how many Bitcoins you have. And so you kind of think about it as a coin and just a representation of the amount, like the number, like the number, the physical number itself on the Bitcoin blockchain that corresponds to your wallet. So that was the very first use of coin. And then what happened is a bunch of different cryptocurrencies launched after Bitcoin because everyone saw what Bitcoin did. And some of my favorites because they're fun. Well, Litecoin, just because that was the silver to Bitcoin's gold. And then Dogecoin, which is just one of my favorites that came out because it's this funny meme with this, if you don't know, this adorable dog on the front of the coin, and I'm a huge dog fan. So people made a lot of these, and when they referred to their cryptocurrency coins, they were generally talking about a blockchain that was had its own set of computers, a peer-to-peer network, right? But just set of people running computers at their home that were validating the software saying how much, what the number was in each person's account. And so when they're referring to coins, what they're talking about were these entries on all these different like Bitcoin clone blockchains that said, hey, you have 10 or you have 20 or you have 30 or whatever of those various different cryptocurrencies. So those were all the different crypto coins. All right. So already kind of complex out the gate. And that just kind of happened for the first several years. And then we had Ethereum come along with its smart contract blockchain. And there's plenty of stuff out there. You should go and learn about smart contract blockchains. We definitely can't cover it all here. But Ethereum just said, hey, we're going to make it even more complicated. So what Ethereum did was they made the first system where you could, on the same blockchain, you could actually track a whole bunch of different types of assets. And from a theoretical perspective, they actually made it so you could track, like any asset. They tried to make it as general as possible. Now they didn't, obviously there's limitations, but they tried to make it really hard to be general so it could represent as many different things that you could want. All right. So as soon as that happened, you had this whole new world of things that you could track, and people needed to come up with a name for it. And so they used the word token, right? And so I would say like the biggest difference between something that's referred to as a coin and something that's referred to as a token is a coin is like a Bitcoin. It is the only thing that's tracked on that blockchain. Bitcoin only tracks the Bitcoin blockchain only tracks Bitcoin amounts, right? Or for all intents and purposes, we'll just keep that for simplification. And that's what's being tracked on that blockchain. So if you have a Bitcoin, it's on the Bitcoin blockchain. And if you have a Dogecoin, it's on the Dogecoin blockchain. And if you have a Litecoin, it's on the Litecoin blockchain. Okay. So then Ethereum came out, and now you could have these tokens. And what happens is you can have a bunch of different tokens, and there's a lot of them. And if you go to CoinMarketCap or any one of these others, CoinGecko is another one. There's a lot of different sites you can go to just look at all the different tokens that exist. And on Ethereum, there's thousands. Okay. And then these tokens are all on the Ethereum blockchain. So unlike Bitcoin, which lives on the Bitcoin blockchain, you could have a token on Ethereum, and that token for that network can actually live on Ethereum. It doesn't have its own blockchain network. So I'll pause there for a second to see if that made sense.
Yeah, I'm trying to digest all of that. And so tell me more about like the practical uses of coins versus tokens. And also, like, side note, when we use the term cryptocurrency, is that like an overarching term that includes both coins and tokens, or does that refer to just coins?
Yeah, so I would argue that cryptocurrency refers to all of the any of the different coins or tokens that someone would use to like transact with to represent some sort of value, like a counter, basically. And so, yeah, I would say cryptocurrency is kind of like general. And coins, their practical use is basically to function like money, right? Or a commodity product. So coins are great. Like Bitcoins are great for storing value. And this is what people buy them for. And that's the only thing that they do. They're really supposed to be dead simple on purpose. So a Bitcoin is just a store of value. And then a Dogecoin is doing the exact same thing, except it's a lot funnier. So like it's a little bit more, they obviously don't have the development resources or any of these other things as Bitcoin, but that's all they do. They're just stores of value for that particular blockchain. And when you're buying one coin versus another coin, you're basically saying, like, I think this blockchain's a good one, or this one, is one that I think will be more used in the future or something. So you're actually just differentiating between the blockchain themselves. Tokens can be a lot of different things, and we can get into that in a second. But the difference between a token and a coin is a token is built on top of another blockchain. So and so the tokens, like most of them, live on Ethereum. And so there's also an Ethereum coin, right, for the Ethereum blockchain. And that is the coin that has to do with the Ethereum blockchain. And that's what's used for the security model for the Ethereum blockchain. And that's what miners get rewarded with. Just like Bitcoin miners get rewarded with Bitcoin, Ethereum miners get rewarded with Ethereum, Dogecoin miners get rewarded with Doge. If you have these tokens, they are on top of Ethereum, but some of them actually have like mining, like proof of stake mining or whatever, and they'll pay you out in their token, but their token is not the security model for the blockchain Ethereum, because the Ethereum coin is what does that. So the biggest difference between a token and a coin is the coin is typically an integral part of the security model of the blockchain itself. And the token can be a representation of a lot of things. That may be like a prepaid credit for an API, like so you can redeem the token for like a gift voucher or something. A token could be a piece of artwork. It could represent, and we have a previous episode where we were talking about artwork on the blockchain. And a token could be like a certificate for your education. So like to say that you completed this computer science course. Something like that. So that would be the difference. And these tokens are representing all sorts of things, and they are resting on top of another blockchain. And that blockchain will have a security model where it pays out the miners to make sure everything's secure in the coin of that blockchain.
Got it. So coins are the money. So when somebody says I have Bitcoin or Ethereum, they're talking about the coin itself, which is, the monetary value. And then tokens, on the other hand, are more just vouchers, but they're not money, right?
That's an okay approximation. There would be some people who would argue that their token is functioning as some form of money. Just like you can have there's all sorts of, like, Amazon credits are basically like money to developers because they're going to use those Amazon credits 100% of the time. So, there's a little bit of crossover there. I would just say, like, and sometimes the tokens can also function on security models. So for those systems that are doing some sort of operation, maybe like an Oracle network or something like that. So the distinction is really not as great as you would think it is, but that's what I think people mean when they're talking about the difference between coins and tokens. And generally, like, if I was to draw a line, I would say you're a coin if you're running your own blockchain, and you're a token if you're running on top of somebody else's blockchain infrastructure.
Got it. Okay. So then when we're thinking about the value so obviously there's so many different coins and so many different tokens out there, and they're all worth different amounts. And so when we're like, who determines Well, I guess the market determines what the value is, but then if you're a user, if you're you or me and you want to buy Bitcoin or Dogecoin, like how do I know which one to go after? Like you would think, I would think there's a big enough community of people out there who love dogs. So maybe Dogecoin can, really be something.
Well, I don't like speculating on investing in the cryptocurrency world. That's not my area. So I'm sure there are plenty of YouTube podcasts where you can go out there and listen to people speculate on their favorite coin and how much it's going to go up or something like that. Not my area of expertise. So can't help you there. The way that I look at technologies are what are the things that I want to use to build the application that I want to build. So when I look out there and I want to build a blockchain domain system, we built on a couple of these smart contract blockchains because they had the technology that I needed to use. And so as a technologist, when I'm looking at these, I'm just looking for what's most useful. And then there's all sorts of crazy speculation that happens on top of that. And I understand why, because if the blockchain that you're using becomes a global standard for something that it's doing, then yeah, that could be something that everyone's going to be very interested in 10 years or something. But that's a game best played by people who are spending 100% of their time on that, and not me. I don't have enough time for that. I have other things I have to work on.
Fair enough. Fair enough. All right. Another big question, something that everybody has heard of, stable coins. Can you break that down for us? Yeah. What's a stable coin?
So these guys just totally broke my previous discussion about the difference between coins and tokens. So what stable coins are is they are tokens, right, on top of a smart contract blockchain. In most cases, they're either on they're on Ethereum, and they are a representation of a US dollar. And so that may be why, stablecoin is a good name, just like Bitcoin was a good name. So, but doesn't mean it makes a lot of sense for how the thing is being explained. But they're trying to communicate that this value on the stablecoin is tied to a traditional currency. And the most common one right now is USD. So there's a Tether as a stablecoin that's 1-for-1 tied to USD. USDC is another one, and that's by, I think it's Coinbase and Circle. They have some sort of consortium to make that one. And each of these things, Gemini has one as well. That is a stable coin that's tied back. And the whole purpose of these is that when you pick up a Gemini stable coin, or you pick up a Coinbase USDC stable coin, or you pick up a Tether stable coin, is that when you get it, it's $1, and when you sell it, it's also worth $1. So their whole job is to make sure that the value stays the same. And the reason why people are so excited about this is you just take one look at the Bitcoin chart, and the thing is all over the place. Like Bitcoin started at, $50, went to 1,200, dropped to 200, went to 20,000, dropped to 4,000. Now we're back at 30,000. It's extremely volatile. And so technologists from the very beginning of Bitcoin launch, they're like, this thing is crazy volatile. How can we make a currency on top that would be not as volatile so that people can actually use it? And there were two camps, and there was one camp who said, who cares if it's volatile? It's going up in value, right? And they're like, it'll eventually become not volatile. And then there was another camp who was like, we should really work harder to try to come up with a solution. And that's how we ended up with stablecoins. And I'm definitely in the work harder camp. And I think it's a good thing that they came up with something that didn't change its value so much, because it's really terrible if I have an invoice and I owe you, $2,000, and I pay you on Wednesday night, and you wake up Thursday morning and it's only worth $1,900, or maybe it's worth $2,100 because I've either paid too much or you've been paid too little. And the only difference is like when, you were sleeping before you got it. And that's not a great place to do business. So stablecoins are invented to hold their value, and the way that they do it is when you buy one, they put $1 in the bank and they just leave it in the bank account. And when you want to redeem one out, they take that $1 out of the bank account and they send it back to your bank account, or at least that would be a way that a very regulated stablecoin would function. We can talk about how different stablecoins work, but that's maybe the regulated stablecoin route.
Got it. I just went through like so many different thought processes while listening to you speak. At first I was like, well, if it's not volatile, then where's the excitement in all of this? And then by the end, I was like, okay, well, stablecoin sounds a lot more practical. So let's go with that.
One of the reasons why I think stablecoins are so interesting is they increase the utility for crypto users. So it's like people are like, why would I want to own a stablecoin or whatever? Because it's not volatile and I don't have the ability to make money like just by holding it or something. And then I would counter with, you can now take these stable coins and use them in various decentralized finance protocols. You can lend them out, just to be real simple, and you can earn an interest rate on these. And of course, this is all risky, so this is not financial advice. But I'm just saying, there's a whole new opportunity set now where, let's say you don't want to own Bitcoin because it's too volatile, but you do have 5 or 10K sitting in the bank, and you're earning 0% interest. You can take that 5 or 10K. You can turn it into a stable coin, and then you can deposit that stable coin onto a one of these protocols on the blockchain, and then you can start earning interest. Now, everyone should go and do their own looking and make their own decisions. But this is a whole new set of ways to earn money with blockchain. So that's why I think it's really cool. Like, I'm really a crypto person. I love cryptocurrency. I've owned it for a long time. Like, I've been in the space for a while. And the more places we open up opportunity sets for people to interact with this technology, the better it is for everybody. So there's a lot of interesting things you can do with stablecoins. I would just point out, they sound boring, but they're actually quite cool.
Yeah, that's really interesting to know. So let's dive in a little bit more into stablecoins. Now that we know the general concept of what they are, talk a little bit more about what are the different types of stablecoins out there.
There's a few emerging types of stablecoins, and there's a lot of innovation here. So there could be even more in the next year or two. But I'm going to try to put them in broad classes. So one is kind of what I would consider like a regulated stablecoin. Now, we don't have an official like government stablecoin yet. But there are some stable coins like the Gemini dollar or USDC where they have a bank account and they guarantee like if you have to put in $100 and then they will give you $100 in stable coin back. And that money just sits in the bank. And I would say those are super safe. And there's going to be more regulation around that because, they want to make sure that that's matched dollar for dollar, because otherwise someone could defraud you by pretending there's not enough there. So that's the fully regulated stable coin. And you're like, well, why would a company do that? Well, they earn interest, right? So like if you buy $1,000 worth of stable coins, you put $1,000 into, their bank account in New York, and then they just go buy bonds and earn 0.5% interest on that or whatever. And then you go and you play with the stable coins on the blockchain because you're interacting with a bunch of things. And then when you cash out, they let you withdraw it, but they've been earning that interest that whole time you've been using it on the blockchain. So that's the business model there. Does make a lot of sense. Regulated stablecoins, check. The next one is commodity-backed stablecoins. These are a little bit wonkier, and the most famous one is MakerDAO, and they were one of the first people to issue stablecoins. So they're super innovative, super early, and they have DAI and SDAI. So I don't want to get into the details too much, but basically you deposit crypto, and so let's say you want to have $1,000, and so they say, well, you need to deposit crypto. So you deposit crypto into the account, and you can borrow $1,000 against it. And you're like, well, how do they do that? Well, they say that if you put the crypto in, because crypto is so volatile, you have to put $3,000 in crypto in order to get 1,000 out. Now that number changes, like how much you have to put in, but that's a collateralized stable coin. And so there has not been a lot of regulation around those yet, although they are looking into it. And I think that those likely are going to get regulated as well in the future. But currently, I would say MakerDAO has been around for 3 years or so, or maybe 5 now. Geez, it's been a while. And they're quite conservative on how they manage their pool. I don't think they've only had like a couple of minor bugs in the protocol, which they fixed. So overall, that team's pretty responsible. That's a collateralized one. And they're much more risky than the fully regulated one. So I think if we're talking about risk spectrum, so we started at the safest one, and those are the regulated, where there's $1 in that bank sitting for you. And then you have the collateralized ones. And then the problem is if Bitcoin price goes down a whole bunch or the Ethereum price goes down a whole bunch, there may not be enough money to redeem one for one. And so that's why those are a little bit risky. And those are in the second basket. And then you have this third basket, which is they're trying to create, and they're called algorithmic stablecoins. And this, I would say, is all the way on the edge of extreme in terms of the risk level. It's theoretically possible. I think that there's been a lot of interesting research around it. And there are several of these, like this year, a lot of them have been tried because of decentralized finance. Just think about it like I would say think about it like you would think about complex Wall Street instruments, because that's what those are. And so proceed with caution.
We'll certainly heed your warning on that. Thanks for that. Well, thanks, Matt, for this discussion about coins, and thanks for breaking all of this down for us. Thanks, listeners, for tuning in. We're going to come back another time and talk more about tokens, do a deeper dive into non-fungible tokens, NFTs, fungible tokens, all the different types of tokens. Thanks so much for listening. We will be back again soon with another episode of the Unstoppable Podcast.